Hello and welcome to TransUnion Africa's podcast series. Thank you for joining me, Denzel Landy, Senior Advisor of Consumer Solutions in the TransUnion Analytical and Decisioning Services for TransUnion Africa. Today, we're going to discuss Zambia's economic conditions and how commercial banks and credit reference bureaus can work together to weather the storm. In the recent while, Zambia has experienced tumultuous economic conditions. The macroeconomic factors have forced commercial banks to increase interest rates, and these same factors have negatively impacted the profitability of commercial banks. Zambia has experienced mine foreclosures on the copper belt, serious drought, and strained electricity supply. All of these have led to retrenchments, which has an impact on disposable income of customers. Due to the serious impact on disposable income, this also negatively impacts non-performing loans and causes them to increase. The greater the extent that disposable income is impacted, the greater the degree to which default rates increase as customers are unable to service their debt. Numerous Zambian banks have increased their interest rates on various credit products such as personal loans and home loans. These interest rates have now gone up to as much as 43%. This is counterintuitive to a certain extent because of the impact it has on both existing and new customers. Existing customers will now struggle to meet their debt commitments with increasing interest rates, and this will lead to higher defaults and higher non-performing loans. On the other hand, you have the impact on the new customers. Because interest rates are so high, customers are either reluctant to apply for credit, or when they do apply, they're not approved because of the repayment. During these tough economic times, there are, however, other options available to commercial banks. The use of credit scoring in particular becomes extremely crucial at this point to allow commercial banks to get a better risk read on customers that are applying for credit. The more information that's available to commercial banks on the customer enables them to have a better risk read of that customer in the assessment process. Commercial banks can also implement risk-based pricing based on this risk view of the customer. This means that customers would be granted loan sizes as well as interest rates which are commensurate with their risk. Lower risk customers will be granted larger loan sizes at lower rates in comparison to high risk customers. During these tough economic times, there's a role to play for both commercial banks as well as credit reference bureaus to work together to weather the storm. Commercial banks can leverage credit risk scores that are available from credit reference bureaus. Commercial banks are relied upon to supply the data to credit reference bureaus for these scores to be developed. The more consistent the supply of data, as well as the better the quality of the data supplied to the credit reference bureaus by the commercial banks, will then enable the credit reference bureaus to enhance their scoring models and produce credit risk scores that are more effective at differentiating risk. By commercial banks and credit reference bureaus working together during these tough economic times, commercial banks can continue to extend credit, thereby still ensuring that economic growth continues. Thank you for joining us for this podcast. I hope you've enjoyed it, and if you have any questions, please feel free to visit our website. Goodbye.